Pakistan has seemingly been on the verge of signing the much-anticipated staff-level agreement with the International Monetary Fund for several weeks now. But the coming week may see the finance minister close the deal. Sources in the finance ministry told Dawn that Finance Minister Ishaq Dar would resume the final round of talks with the lender tomorrow. The official also said that the deal couldn't be signed this weekend because of delays in compliance with certain measures from the State Bank of Pakistan. This agreement would release $1.1 billion, part of a $6.5 billion bailout package the IMF approved in 2019. Analysts say that this bailout is critical if Pakistan is to avoid defaulting on external debt obligations. Trading on the stock market commenced on a positive note in the outgoing week as investors expected the signing of a staff-level agreement with the IMF. KSE 100 index closed at 41,794 points after gaining 457 points from a week ago. Meanwhile, the Pakistani rupee appreciated by 1 rupees 53 paisa against the US dollar as interbank market closed on Friday. Arif Habib Limited said that the rollover of a loan from a Chinese bank further fueled the momentum in stock prices. Investors became upbeat when Finance Minister Ishaq Dar said that the government would reach the staff-level agreement with a Washington-based lender for the 9th tranche of the extended fund facility in the next few days. The reserves of the State Bank of Pakistan also increased by $487 million to $4.3 billion after the disbursement of a commercial loan from China. Gross inflows to Roshan digital accounts also witnessed a growth of 14% on a month-on-month basis in February. Weekly inflation clocked in at 42.27% year-on-year due to the rising prices of edible oil, pulses, and vegetables. The short-term inflation is expected to intensify further as the full impact of rupee depreciation, hike in general sales tax, and higher energy prices has yet to reflect in the official data. This week, the government formally raised sales tax from 17 to 25% on 33 categories of luxury items, including high-end mobile phones, imported food such as chocolates, cornflakes, and sauces, as well as crockery and toiletries. Startup-focused lender Silicon Valley Bank Financial Group became the largest bank to fail since the 2008 financial crisis on Friday in a sudden collapse that roiled global markets, left billions of dollars belonging to companies and investors stranded. California banking regulators closed the bank on Friday and appointed the Federal Deposit Insurance Corporation as receiver for later disposition of its assets. Based in Santa Clara, the lender was ranked as the 16th biggest in the US at the end of last year, with about $209 billion in assets. Specifics of the SVB bank's abrupt collapse were a jumble, but the Fed's aggressive interest rate hikes in the last year, which had crimped financial conditions in the startup space in which it was a notable player, seemed front and center.